Some of those are tricky questions, Alan. I'm like, do I know? I'm not sure if I know. I think I know. Maybe I know. I don't know. That's what these are good for.
That's why I try to, I try to just hit on what I think, is people need to know and what are likely like, it's very easy not to know. We just don't teach this stuff well. I might have to break this up into two parts. We'll see. Just with the poll and going through that, and then since we're in the open season, especially, I wanted to at least touch on the health insurance and stuff like that, and make sure everybody's looking at those options appropriately. Okay, first question is, do you have umbrella insurance? Two out of 11 said yes. 5 out of 11 said no, and not so 9 out of 11 people don't have umbrella insurance or don't know what it is. That's something we need to fix right away. This is so important, and we'll get into it. But what it is a very affordable additional liability protection for your auto and homeowners insurance. So, and it covers like negligent acts, but we'll get into it. It's super important and super cheap. So it's something to take care of immediately. Let's see. Number 2 is, if you're not retired military, this is a kind of a veteran specific topic in a sense, but it's also important for everybody. Do you have a high deductible health plan? 3 out of 10 do, and 7 out of 10 do not. I guess I'm curious there, if some of those are retired. I should have said had an option retired military, but if not, we'll go into the different plans. But a high deductible plan, especially if you're young and don't spend a ton on medical, it's an absolutely great way to go to have one of the best retirement accounts, really, this health savings accounts. But we'll go into that. Number 3 is, what should be the basis of coverage for your umbrella insurance policy? Laura, I think that's what you're talking about. Like, I asked them. Most people said value of the assets you own, amount of total debt, 1 out of 11, your net worth, 5 out of 11. You really should cover your net worth. So, and that just protects you in case of a suit, so that they can't come out take anything from you. If you have a separate business, though, you got to understand this is a personal umbrella policy. You need separate policies if you have your own business on the side that you're operating, to cover any kind of suits against you with your business. Okay, fourth one is, when was the last time you checked your liability coverage amounts on auto, homeowners, and or renters insurance? Last time policy renewed. Okay, good. 7 out of 11. Year ago, annually, 1. Okay, good. I thought there would be more, actually, of when I initially signed up, because typically, I think of like, you're just, redoing your policy renews, and then 1 out of 11 said, who cares? Good. We'll go into that. And that goes into the umbrella policy, because for an umbrella policy, you have to have higher than the minimum state limits. But this is about really protecting you in case something bad happens, which is the whole point of insurance. Okay, let's see. Whoops, I didn't mean to go there. Number 5. Do you have life insurance outside of employer-provided group life insurance? 5 out of 11 said yes. 5 out of 11 said no. 1 out of 11 said, I don't know, get off the end. Okay, it's important to at least know, but we'll go into that and what the different options kind of available are for you. And then, and here it goes into what people have. So not everybody answered, but 5 out of 10 have term life insurance. 1 out of 10 has whole life or permanent. None have universal life. Actually, I'm glad to hear that. 3 out of 10 have none, and have insurance. One person has it but doesn't know what exactly they have, which is understandable completely. Go to the next slide. Number 7. How often do you calculate your net worth? Okay, 3 out of 10 have never done it. 4 out of 10 annually, 1 out of 10 quarterly, and 2 out of 10 monthly. Monthly, I think, is a bit excessive. I mean, I personally do it quarterly. A lot of people just do it annually, but and for those that have never done it, I would recommend starting it. And I've got Laura, I think you've downloaded that net worth tracker. But I've got a net worth tracker on the website that you can use. And one of the reasons I think everybody should is, even if you, like young people that might even have a negative net worth, like with student loans or whatever, it's still, every quarter or every year, as you see that number improving, it's very motivating. And it really, I think, helps you in saving more and investing more, if that makes sense. I find that's the case for me. And on the tracker, I have it like it adjusts like what's your quarterly change in net worth since you've begun, and then it breaks it down also to a monthly, like how does that translate monthly. And that's that kind of thing, as you see your situation improving, is very it just encourages the right behaviors, I think. Okay, do you have an IRA? Yes, go ahead.
Quick question about that. Would that include your spouse as well, or is it just you?
Absolutely. No, but it should be a
household
net worth. Yep.
Okay.
And especially, are you in California, Matthew?
No, I'm in Georgia, but it's two different stories. If you just use me and then you add my wife into the story.
Yeah, but you guys you're since you're married, it should be the combined. And why I asked if you're in California, there's also community like certain states, like California is a community property state, which has like basically half of your income, half of that is your wife's, period. Like it's split 50-50, and so and it's kind of those southwestern states that are community property. But anyway, it's just, I would, yes, you want to include your spouse on the net worth. Okay, sorry, that number 8, do you have an IRA? 3 out of 9 have a Roth, 1 out of 9 has a traditional, 4 out of 9 have both. What's an IRA? Good, nobody's. And then what did I say? Choice 5. No, I think I wrote none. Which I assume that's what they're saying. Most people, I think, will need both ultimately, and I have both because there's income limits on actually both types of accounts. But I'm a big fan of the Roth IRA, and especially for any of us that have that use a 401k and contribute, the income limits to deduct a traditional IRA contribution is super low. And so the best thing to do is, if you can, is contribute. If you're above the income limits for a Roth, it gets into the backdoor Roth IRA. So you need both. You contribute to a traditional non-deductible contribution, and then you actually need to let it sit there for a while. Something I've changed, I learned about. And then say towards the end of the year, you convert all that to Roth. You might pay a little bit of taxes on the growth that you've had at that, through the year, which is probably not significant, but then it'll grow tax-free forever. And so you need both accounts, and you just keep the traditional open and make your contributions there. Any questions on that? I know that was a quick talk about.
You're rolling the traditional into the Roth?
You're not rolling the traditional, you're converting the traditional to a Roth. Does that make sense? So it's rolling. The terms are important,
Right.
So what you're doing is you're converting all that money in the traditional to Roth. And so we'll go in, Matthew, we can talk about this more, because there's certain things like the Pareto rule you got to really understand before you just go and jump into that. But it's a good thing to know how to do and to execute it properly. Let's see. Okay. And last question. Oh, interesting. I didn't count the numbers correctly. Okay. Do you max fund? I have 2 more questions. Do you max fund your IRA annually? 4 out of 10 said yes, 5 out of 10 said no, 1 out of 10. So 60% don't fund it annually totally. Okay, hopefully that changes. This, after you get your max match on, for Viasat, it's 10% of your paycheck. Once you do that, then I would max fund, your HSA and your IRA before you go back and add more contributions to your 401k. Hopefully, over time, people can max all of those out, but I'd much rather see 10 out of 10 contributing, max funding their IRA annually. And if you haven't done it for 2023 yet, you have until tax day. So you have until April 15th, just over a month, to fund as much as you can. So when you go in and contribute it all, it'll ask you at this point what year. Make sure you're contributing to 2023, because tax day, that's gone. No more chance to contribute for 2023. And you have all of the way until tax day 2025 to contribute 2024, make 2024 contributions. Make sense? What questions do you guys have about that?
Oh, that makes sense. The only I've discussed with a buddy before taking my 401k and rolling it into a Roth.
Rolling into a Roth?
Converting it into a Roth.
Okay.
And that way you're paying the taxes on it today versus, what you don't know what they're going to be in retirement day.
That's a large consideration. You need to, that's something to every year to consider, and how much you want to do. And do you want to convert, or do you just do Roth contributions to your 401k? There's a lot of considerations there that I would slow down. You just you don't want to you don't want to convert it all at once. Like you would have such a high tax bill, if you had a large.
Yeah, I can't afford that right now.
So what people do is you roll it into a traditional down the road. I wouldn't even do that now. Just keep it in the 401k. But down the road, what you could do is roll it into a traditional IRA, which is ultimately what, once you leave work, that's what I think most people should do. Then annually you convert a certain amount up to then you're looking at tax brackets. How much money do I have coming in? What's my income? What tax bracket am I in? Okay, how much do I of that traditional money, which AIRS considers income, do I want to convert and pay taxes on? And so you look at tax brackets and how much to convert per year to get that tax-free money into the tax-free Roth bucket. Make sense?
Yeah, it makes sense. Perfect.
Okay. I think that's it. So yeah, we're gonna probably have to. We'll probably have to break this up into 2 different discussions, but let's get rolling. So we'll quickly, here's the agenda, and we'll get through as much as we can. We might end up going through umbrella insurance and doing, maybe I'll just do another discussion next week or soon after to cover the rest. I don't want to run too long over. I'm sure people have other things to do it. But I guess I should slow down or make the polls smaller, but I think that's important stuff too. Okay, so this is the Viasat's plan, the snapshot kind of what you can do. There's a new plan called the Blue HPN EPO, which I have some specific slides on, but this shows, there's next 3 slides are just basically the summary of all of these. If you're retired military, don't do the high deductible plan, because you can't contribute to an HSA since you have TRICARE. It's not allowed. I mean, I wanted to do that too, but it's it's not allowed. So instead, I would go with something that's going to cost you less per year. You know what I mean? Like as far as out of pocket. And just so people know, benefits are available for anybody that works 20 hours on a regular basis. If they don't work 30 hours, the rates will be a little bit higher, but at least part-time workers still get these benefits. And then that Alex link at the bottom walks you through, kind of based on how you answer questions, what plan makes the most sense for you. Has anybody used the Alex before to check their benefits? It's pretty good, I think. I mean, it gives you based on what you say, how much you're going to use it. So here's this goes in more. Now we're talking about kind of the specifics: chiropractor, massage, prescriptions, and things like that. So, but if you're not retired military and you don't spend a ton on healthcare, the high deductible plan and the HSA is the way to go. Because that HSA is amazing. Only 4% of people use it properly, or properly by the best way you can, I guess. But I know Christian does it and is a big fan. Here's just a quick summary of the new Blue High Performance Network Plan exclusive provider organization. It's a little bit cheaper. But I don't know if it's, so if you're an employee only, it's like, okay, we get these taken on our paycheck bi-weekly, right? And I'm not counting the wellness benefits, but if you didn't do any of the wellness elevate benefits, it's the EPO plan is 56 for just an employee versus 70 for the PPO plan. $118 for employee and spouse versus 151. Family and employee and children, $111 for the EPO, $147 for the PPO. And then for employee and family, $179 versus $232. So there is some savings, but notice if you don't use the in-plan network, you pay all the cost. So one time, like, one visit, you've probably ruined your annual savings. So to me, I would just do the PPO if I were choosing between these. And it depends on the area you're at, but it sounds like they think 90% of people will be covered. But there is some savings. But I mean, if you're using the wellness benefits, which are not that hard to meet, that saves $42 for an individual, up to $84 for an employee and spouse per paycheck. I mean, that's pretty significant. It's kind of like one of those, be an idiot not to do that. Okay, any questions on this? Okay, and then here, this just goes into the dental. Something to, well, I also want to talk about this. Like if you have, I got that Invisalign stuff for this last year, and it's, that's like, I don't know, it's a pretty penny, but the orthodontics, they'll pay 50% and then a maximum of $2,000 for a lifetime. So these are just things to know, because if you need much dental work, you can quickly finish your maximums rapidly. So it's something to think about, and it's something to think about when you're looking at your HS or your FSA, the flexible spending account. And that's something, that's why I want to bring this up, is these things matter as you're trying to figure out how much do I contribute to to an FSA, et cetera. But we'll go into that next. Any questions on the dental? Okay, now I just want to, this is significant, but this is something great about our health plan, I think. I mean, you need 3,000 points on the Elevate, which even just doing like the medical exam and doing your, you can get like a 1,000 or almost 2,000 points. So, I mean, most of it you can get. One of the things to watch though, which they've changed, is there's my choices and then the ones that are recommended. And you can only get now 1,000 points from my choices. So you can keep doing all these my choices, but not getting any points. Which sounds kind of like, whoa. So it's something to pay attention to when you're looking at Elevate to get your wellness credits. But take advantage of getting your physical done, all those things. You can rapidly get your 3,000 points, as you should. And then those have already started right now. So it started March 1st. So take a look, because you can only go back like 2.5 weeks, to keep up with those. But interesting. Okay, and this I just quickly, if you guys want to see, I'm not sure how familiar you guys are looking at the Viasat benefits, but there is a lot of additional, like that we don't even have to think about benefits that you have from short-term disability, long-term disability, 2/3 of your pay up to a certain amount. We have group life insurance up to, 3 times your base salary. And apparently if you have to look, but maximum 750K, but if it happens at work, it's, I believe, 10 times your salary. But these are just additional things that are good to have, but those go away,
Well,
you stop working. Yeah.
I'm just thinking about something that we did this year for the healthcare that my group of field service guys, we stumbled across this. Oh, it's a procedure you can go. I think you do it through Workday. I can find the email and I can send it to you, Alan, so you can send it to everybody else.
Mhm.
But it was, you went online and you said that you went to one of 3 appointments for the year, which was your yearly dental, your yearly physical, or your annual. There was one more that qualified you. And then, so I said I did one. I said my wife did one, and they gave us 3, or they gave us each 3 $50 checks back. So I got $300 back just for going to my appointments this year.
Okay, nice. Yeah, that's, if you can send me the link, I'll post that in the Slack channel and just send it out. That's good to know. If you get in, yeah, that's free money.
Yeah, I've been with the company 5 years.
The other
This is the
one
first year I've known
the
about
other
it.
one's probably vision, is what I'm guessing. The other appointment, you think about physical, get your teeth, dental exam, and then a vision check. So, okay, let's see. This is for people that are retired military. Other options if you don't want to go with like the employer sponsored, or if you leave, leave the W-2 work, there still is federal employees dental and vision insurance program, which is, I mean, you can see the cost vary significantly. I just did family, you can go look at individual, et cetera, but $75 per month to up to $205 per month. And then vision plans, much cheaper, 20 to 44. So, but those are options for retired military and reservists, retired reservists as well. Because obviously, I guess based on that, TRICARE doesn't cover dental and vision after you leave active duty. They only cover medical. Just I should have said that first. And here's some reservist options. So this is assuming you're not on active duty. If you're active, in the reserves, you have the same basic medical care as active duty personnel. But this is, these are options for people to get medical and vision, and then separately there's a dental plan that you can get, which is the next page. Oh, somebody, by the way, chat, I don't monitor very well, so I'd rather just people talk out loud. But let's see.
I was just
points for
point.
health.
I was making the point of that 1K my choice. It's like that was all the activities. If you needed to cram at the end of the year, you could cram easily, but now you can't. So I got lucky with the health screening, but I probably wouldn't have got my benefits. So you got to kind of be more on it than
you gotta it's something to kind of put on your schedule, just to check at least every say, I'd say every 2 weeks, maybe go in for a day, and just go through it. So you don't miss, like the simple ones like working out 8 times a month, 50 points each time.
Right. And it's not hard. It's very easy to get max points.
Exactly. It is.
Now
if you wait until December, you could put yourself in a hurt locker. Exactly. And the 2,000 points for the medical, the physical, that also depends on your numbers. If you've got to have your glucose and other things, in blood pressure, etc. All those come in. You get like 500 for just doing the exam, and then other things for.
Right. I believe you can retake it if you think you can get better scores. So if you do that earlier in the year rather than the end, you have time to fix that. That's something you want to do.
That's good. That's good.
One thing I found, the best day to go and do your points is Wednesday, because That allows you to go back
But the
not just
furthest
the week before, but
Yeah,
2 weeks
perfect.
before.
Okay, good. No, that's a good call. Exactly. Because that's what I was
Yeah.
saying. It's like 2.5 weeks, but right, it depends on the day. So no, that's a good. So put it on your calendar.
And I also text my wife about every 2 months to just be like, hey lady, where you at? Do your thing.
Yep. Okay, let's see. And I do, aside from just getting the points, Nathan, I like the idea of getting that physical twice a year anyway, especially as it, might as well get your blood test to see, see where you're at.
Yeah. Make sure you're good.
Yeah, exactly. And that's, so we're going to get into, okay, this is a dental as well. The HSA. And FSA. So the one concern with the HSA, and they've proven this to be true, is because people don't want to spend money, they just don't go to the doctor. Stupid. It's your health, okay? Do what and you still, like, things like physicals and stuff are free. I mean, but it's your health. Who cares how much you have in your HSA or in everything if you're dead? So take care of your health. And see the doctor as you need to. Sorry, a little rant there, but it's too true that too many people don't. And I was just hearing on some podcast people talking about it, that they don't even use it because they know they have health issues, but if they're on the HSA, they don't want to spend the money. It's just but the best way to use an HSA, if you can, so an HSA, you can contribute, as you see here, for this year, $4,150 up to $8,350 for a family. And this money, the best way to do this is you invest it and you don't spend it, and you pay for medical out of pocket, and you save those receipts. Put them on a Google Drive or somewhere, scan them, and then you pay yourself back. You can reimburse yourself with that HSA money years later. 20, 30, 50 years later, when that money's compounded so much, then you can just pay yourself back for all these things you paid out of pocket. What's cool as well, so that money you don't lose, just invest it. And if you have to spend some, okay, but the idea is, if you can, invest it and just spend medical out of pocket. FSA, that's money, the flexible spending account, that's use it or lose it. And that's where you need to really calculate. Why I brought up kind of orthodontics and stuff like that. So you got to consider, hey, what am I buying? What am I going to spend this year? How many glasses am I going to, am I going to get glasses? Am I going to get, am I going to spend a decent amount? And that goes into your calculation for your flexible spending account. Even if you have an HSA, at least with our company, you can have a limited use FSA, which you can use for, not for medical, but you can use it for dental and vision. Some companies apparently can use it for medical too, but not ours. That's at least, and so you figure out that's also tax-free money as well. Unlike an HSA comes out tax-free. You also don't pay FICA, but it grows then tax-deferred. And if you use it for medical down the road, it's tax-free growth. So it's like the benefits of a traditional and a Roth. It's actually quadruple tax advantage because you don't pay FICA taxes as well. Amazing benefit. Go ahead.
Can you not use HSA for dental?
You can use it for all that.
No,
no.
This is all good. I'm thinking of switching this year, so I want to make sure I have all the info.
But what I was saying, so making it a better way to save that HSA, keep that HSA money invested. You can also contribute to an FSA and use the FSA money towards dental and vision, and that comes out tax free as well. So you got at least 30 to 50% savings in California,
right?
Just on that money, But that's use it or lose it. So
you got to do that.
Really do the calculation. Go, okay, what am I going to spend this year? And that's when I decided, like, okay, I'm going to get the Invisalign this year. That's going to be really costly. So I took a lot of FSA money, but you can also use it for you can go to get Pepto-Bismol at the store, and that you can use your FSA money. So there's ways to do it, and websites that talk about different things if you're needing to be able to spend your money, like kind of like over-the-counter drugs, etc., that you could use.
Needed to, I could use it for dental. Thanks for answering that.
Okay. let's see. Okay, what questions you guys have about this? We kind of quickly touched on this, but HSA is great, but make sure you still take care of your health. Try to invest it and spend out of the pocket. Retired military, forget it. You can't use it. But you can use the FSA. FSA though, use it or lose it. So definitely calculate, come up with your best guess of how much you're going to, spend in medical, dental, and vision, and go from there. Okay. And this is just on our updated for Viasat, their contributions they provide to the HSA. And then they said they'll be coming up with like the next year's amount here not too long. By the way, on a different note, you guys know about the mega backdoor Roth?
I was hoping you would talk about it.
Okay. So it's not official yet, but I've been pressing for this for a couple of years now. And initially they were just kind of giving me the Heisman, and I was like, so Here and I started talking to someone, hey, everybody go email benefits and say, why don't we have this? And finally, after 2 years, they got it approved by the 401k committee. And now they just need Empower to adjust something and to the plan, which should be simple as heck. I called Empower, early on, and I know they do this with other employers. So I think this will happen. But so the mega backdoor Roth, this is the 401k is, for 2024, if you're under 50, you can contribute $23,000 a year, right? And then you get the employer match, but under that 401k umbrella, you can really contribute up to $59,000. I mean, it's huge, but you can't do it your from your paycheck. You know what I mean? As employee deferral, but you can't. But the employer match goes in. If there's profit sharing, that can go in, and then plans that have two things. What's allowed is after-tax contributions, and then secondly, in-service distributions. That's what makes it a mega backdoor Roth. And so what it means is after-tax contributions. You have to already be able to contribute the max anyway, the $23,000. And if you're 50 and over, there's another $7,500 catch-up contributions you can make. But if you have additional money, instead of it going into like a brokerage account where you're going to pay capital gains, what you can do is contribute that after-tax money to your 401k account. It's not Roth. It's not really traditional. It's kind of traditional, I guess, but it's after tax. So you've already paid tax on that money. But so that's the after-tax contribution portion. The second part is the in-service distribution. And that's what Empower needs to update. So what that does is it could be monthly, it could be semi-annually, whatever, but you can take those after-tax contributions and roll them into your Roth 401k or a Roth IRA. And then from that point on, tax-free growth forever. So you could contribute up to let's say somebody that had we get a 5% match. And if you had the salary where you got the max match from Viasat, you contribute your $23,000, and then half of that, $11,500. So that's $33,500. You've got another almost $35,000 that you could contribute to under that 401k umbrella, and that could all be additional Roth contributions. You pay taxes on whatever gains you initially had until that in-service distribution, but then it'll grow tax-free growth for life. It's amazing. So anyway, it looks like 2025 we'll have it here. So that's good news for us.
Quick question, Alan.
Yeah.
The seed, you'll get that every year?
What's that?
The seed money, this one?
Yes. So long as you're using the high deductible plan.
Correct. As long as you keep enrolling, but it's not like a one-time thing just to start. Yes, every
that's
year
that's
you
it.
keep going, you'll get it.
And,
Okay.
and it changes, and it grows like you saw. It went up from one year to the next a decent amount.
Yeah,
And
I know it's gonna be 15 for family this year. I don't know what
okay,
the other ones are because
yeah,
15 is what would apply to me. So
okay,
thank you.
cool. And additionally, just so people know, like you can switch out of these plans. You can do this, and then let's say somebody's having children and they know it's going to be an expensive year, relatively speaking, medical. Then they could go back to PPO and save, but you'd still have that HSA money that you've already invested growing. And so, it's just something to consider. It doesn't mean you're stuck in the same plan year after year. You can move in and out of both. And then if you have one and you have kids up to 26, if they're under your healthcare plan and you're high deductible, that child can contribute up to the family amount to their own HSA. Amazing. So
with the HSA, it doesn't let you contribute more than the 26 weekly dollar amount. So you can't front load it, which is very annoying.
yeah, it's still a good deal. I mean,
Yeah, it's still a good deal, but you just can't front load it.
You can't front load it. So front load your Roth IRA then, if you can't, that's something you could front load. Okay, let's see. Okay. Umbrella insurance. Okay, so this is personal liability umbrella insurance. Usually people just hear about it as umbrella insurance. But what this does is protect against negligent acts. You're in a car accident, you're at fault. Or who knows, such a litigious society. But I think of even like your house, somebody slips on something and they take you to court. It's additional liability, both for your homeowners and auto insurance, and it's so cheap. It's so important, and it's cheap because most of it's it never happens. But what if it happens? You get in somebody, like this example, the lady slipping down there, they come and sue you. All that you've worked for could be gone just like that. But if you have umbrella insurance, $150 to $300 a year for $1 million in coverage. It's so it's something. That's why I said people that didn't have it need to call up their insurance company today. And one, you need to know what your net worth is. If you don't know your net worth, it's not much of a difference between if you're but you want, like, it's usually in $1 million increments, so 1 million, 2 million, etc. So depending on what your net worth is, at least get it started. And it's you will have to update your increase your state limits so that covers more. And if you look at the state limits, like, it's crazy. Like 15, 30, and 5. I mean, in reality, those would not cover any of them, like medical costs. If somebody's really in an accident and there's injuries. But we'll go through some examples just showing what happened, how umbrella insurance works. But like for USAA, it updated, from California, from, the minimums of 15, 30, and 5, it goes up to 300, 500, and 100. So your auto insurance goes up a little bit. It doesn't go up hardly anything though. But it's worth it. And then, like I said, get as much as your net worth. So another reason to use that net worth tracker and figure that out and keep up with it. Okay, so go through a couple examples. So John has $1 million umbrella policy, requires $300K per person, as mentioned. He gets in an accident and there's a $750K suit against him. So the auto policy immediately pays, because that's under those limits, $300K. The umbrella policy covers the rest. If you didn't have the umbrella policy, guess who covers it? You. Is that worth $150 to $300 a year? Okay, now, so if you're going to get the umbrella policy, it's at the same company as you use. They're gonna make you update your your minimums, that'll be part of it. But if somebody could go in later and go, oh, I want to save a little bit and go back to those, like, California minimums. Well, let's say the same thing happens, get in an accident, have a $750,000 suit. Now what happens? Okay, we just went back to that. Instead of paying $300K, the auto policy, it only pays $15K. To have that umbrella policy, you were supposed to have up to $300K. So you're responsible for that difference. And then above $300K, the umbrella policy will come in and pay for the rest. So the umbrella policy will still pay the same amount, $450K. But now, because you were an idiot and try to save a buck, you're going to pay $285,000. Don't try to game the system. Just up the limits, the minimum limits, and can be protected. Okay, coming on. Let's see. Okay, life insurance. So why do we need life insurance? What is it for?
In case you die.
Yeah. Well, in case you die, but what does that?
Well, I mean, as in, it'll cover.
If I die, what do I care if I don't have any money?
Like for me, for all of our debts, my spouse will have money to be able to cover that.
Okay.
Like for us, we were supposed to be looking at. We just recently purchased a house, so something were to happen to me, that's now, $450K of debt that she's now responsible for, and I'm the sole breadwinner of the family.
Yep.
But, yeah.
Okay.
Good. Kind of bad for her, right?
Yeah. Yep. Anybody else? Any other thoughts?
Can't you use it while you're alive?
Say again. I'm sorry.
I said, can't you use it while you're alive?
You can't. Well, it depends on what it is. You're talking about cash value life insurance, right? You can take loans on a life insurance. That's where I invest money, though, separately. That's why I have a brokerage account and other savings accounts. But that is one option. But I don't think of it as, it's not an investment. It's protection. It's really just like Nathan, what you were saying. It's if you go away, and is your spouse, is your family taken care of to make sure they're not in a terrible situation. So and there's several ways to calculate how much you actually need, different, but it's exactly income replacement to support insured's dependents. Income for the readjustment period, it's figuring out, like when you go, tragically go away. Financial support for the kids. Hey, you can use this money for funding their education, etc. Just like you said, Nathan, mortgage, debt, and then income for the surviving spouse. So that's really what, the whole purpose of life insurance is. And so what if you don't, Matthew, as you mentioned, what if you said, well, what if I don't care if I die, what if you don't have any dependents? Or do you need life insurance? What do you guys think?
I think it depends on the state you're in, because some states have familial laws, and it depends on your brothers or sisters or parents are still alive, probate laws, and there's all sorts of things that it depends upon.
Probate, that's all more estate planning, not insurance planning, I would say. And there is like ILETs and things like that as far as as far as trusts and estate plans, but probate's all about whether you have trusts in place, because that could be a costly hit to your net worth if you don't have your estate plan. And that's going to be my next big topic we go on to, is estate planning, because it's so overlooked too often, and it's so important. But here's the thing about insurance, about, hey, I'm single, I don't have any kids, it's just me. Here's the concern: are you always going to be single, with no dependents? And what if you get a medical condition, age and future, potential disqualifying, medical may be a consideration. So it's just something to think about, whether, I think of, I know people that you think of colon cancer, how many people are getting that young now,
I
and
just had a buddy survive it.
yeah, same. But it's scary. So it's just it's just something we wanted to throw that out there, just for people's consideration, additional things to think about, even though aside from just your dependents, okay, here's some just us talking about, hey, you do already have some free term insurance through our employer. And you can later, you could, if you wanted to convert that later. And there's a link for just about, the actual, details on it. But I think of this as a bonus, uncertain term insurance. Because here's think of the layoff, this doesn't stay with you if you're no longer an employee. So that's why I wouldn't consider this as part of my life. And when calculating your life insurance need, I wouldn't, this would be bonus money. Does that make sense? But it is nice term insurance that we provided. So, okay. Now we're going to quickly hit on the veteran topics, SGLI and VGLI. So they've upped it. It used to be 400K, that I think for most of us recall, but it's now up to 500K. And also for VGLI, it's still the same. Sorry, that's wrong. It's 6 cents per $1,000. That's a typo there. But in general, coverage, ends 120 days after separation from service or retirement. But you can convert to VGLI within a year and 120 days. If you have serious medical conditions, though, they would want to do it within 240 days, since you don't have to demonstrate good health. And that's one of the considerations really for VGLI, because I think of it as really expensive term insurance. There's the premiums get every 5 years, they go up, and you'll see I got a table in the next one. But the people that would want to use this and like survivor benefit plan are those that have health risk, have serious health concerns. And that way, if you don't think family longevity, it's worth it, to protect your people, especially since you probably couldn't get other insurance likely. But look at these costs. This is per month. So once you hit 70, it's over $1,000 a month for VGLI. 80, that's $2,250. It's term insurance. So it's if you don't pay the premiums, it would come out of your pension. But still, isn't that significant? And people don't realize that, and it's not well explained. For military personnel, we don't talk about this at TAPS or anything, or transition GPS or TRS, whatever. But okay, I'm probably gonna. We're coming on the end of the hour, so I'm gonna hit survivor benefit plan, and I think cut it from there, and then we'll go back and we'll go kind of deep dive into life insurance, determining how much you need, and then the different types of insurance, if that's all right. And I'll schedule that in the next week or two so that it's fresh. But I know people are going to need to drop. So survivor benefit plan, though, this is kind of an expensive term insurance as well. It's 6.5%. It covers up to 55% of a service member's retirement pay to dependent or dependents. And it's automatic if 55% for people retiring military, unless you just choose not to, and you have to have the spouse sign that they agree not to do it. So, because I know people that get FBP and get a term, term policy insurance, and do that instead. So, save them money. Here's the amount. Look at this. I gave a couple examples: an E7, an E9. You know, like different years of service, what their retirement pay is, and then what the SBP premium is. I mean, look at that for a colonel, the 30 years. So, you know, he's got a great retirement paycheck, but that's a pretty steep insurance payment for SBP. So here's considerations though on it. What's your health? You know, what's your longevity? You know, women live longer than men. So if the man's a service member, typically, and you're not in good health, hey, this might be the right decision. But if you're not, this might be not the right decision. And it also depends on your current financial situation and comparing against, like I said, against other insurance. One thing it does sorry, I thought I wrote that down. So you pay, I think it was on the previous slide, you paid up on SBP after 30 years of paying it and over 70 years old. So, you know, most people that retire from the military are 40 plus, but, you know, got people going at 18 through 20 years, they could be paying on it for 32 years. But so it's like a paid up, like kind of like a whole life insurance that's paid up once you've paid it for 30 years, but it's not cheap, you know, so just a consideration. But I'm going to cut it at here since it's 1 o'clock and see if there's any questions. And if you guys are agreeable, that way we'll go into details of life insurance, how much you need, and all the different kinds, from term life, whole life, universal life, and different options next time. Does that make sense?
Yeah.
Okay. What questions do you guys have for me? Yeah, have some. I'm not gonna go to the last slide anyway, real quick, just the summary. Whoops. Here's your homework. Yeah, I had a feeling when I was going through this, I'm like, okay, I think I have too much for one presentation, but I'd rather not rush through it and do. Sorry, let's get right. Okay, and I'm going to share again. I almost ended instead of clicking share. Okay. And share one more time. Let's see. Okay, really quick. So these are just these are the veteran specific topics. You know, we've hit through the first couple. I have slide decks and recordings for the previous ones if you guys are interested, and then we can redo those as well. Obviously, this is turning into a part 2, and then these are other ones. If you guys have topics that you're interested in, let me know, and we can add those to the list. But this at least covers us for about a couple of years, but then here's just the other in general topics that that we've already covered just in the regular, and we repeat several of these. And for anybody that's around, I'm teaching a financial fitness series at the ECI Encinitas YMCA. It's tomorrow morning, actually at 9 a.m. It's going to be the second Saturday of the month at 9 a.m. And if you're not a member, it doesn't matter. They'll give you a pass to come in for this. And we're doing the retirement investing vehicles and strategies tomorrow for that. But these are topics. There's other ones you want. And then just like hopefully you guys, any questions you guys have about the umbrella insurance, and we'll get in more, like I said, in life insurance. And then here's your homework. If if you don't have, a lot of people didn't have umbrella insurance, so call your insurance agent, just and work with them to get umbrella insurance based on your net worth. I got the link. The website has a free net worth tracker, which I can show you guys as well what that looks like. And we'll hit on this, how much life insurance you need later, because there's a couple different calculations of how to figure that out, and that's something you want somebody to assist you with. I'd say most likely they'll help you, but you need skin in the game. And then something you should do every year: verify all your beneficiaries on your accounts. I think imagine people going through a divorce. I've heard terrible stories. So, and the beneficiaries on accounts is the priority over everything else. Whether you have a trust, whether you have a will, anything like that, beneficiaries are number one. And then if you haven't already, update your contributions to your 401k. Get those 2023 IRA contributions pushed in before tax day. And then figure out your FSA needs, as that's during this open window, which ends, the last day is March 20th. Let me see what I'm going to quickly just go to find that net worth tracker so you guys can see what. I'm going to escape out of here. Let's pick into. There we go. Okay. Okay, this is it's actually broke this into two. So this is kind of what I use for net worth tracker, and I probably could, but I don't put it in my car. Like, that's just a wasting asset in my opinion. It's not really an asset, I don't think. I mean, it is, but it's depreciating. But I've got like cash equivalents, taxable account investments. What's all your Roth money? Here's your traditional stuff, and then other things like if you have charity, stuff like that. Home values, what you owe versus what it's worth. I personally don't update it all with what they say. I want my net worth to change based on what I've done. So I leave it at the purchase price, or if we do remodels, I'll put some money in there, but I don't go with what the market says, what Redfin, et cetera, it says the worth is, because it's not real, and it's not tangible right away anyway. It's not liquid, so I'm more concerned with my FI money, how much liquid stuff I have. But then it breaks it down into what fraction is, and this is just a sample. This isn't my numbers, but this is just a sample of what it shows. And you can see in California, often if you own a home, that's so much of their net worth, very often, just because of how expensive property values are here, which also a lot of times limits how much they can contribute. But any questions? This is on the website as well, if you guys are interested. So what are your final questions?
Could you
Credit card, 20,000.
could you what's it called? Give us the what's it called, the Excel sheet, I guess? Is there like
It's on the
a
website
template?
for free download.
Oh, okay, I see.
Yep. So just go to
okay.
that website, and then under the resources tab, you have to subscribe, but I don't send out any, and it doesn't go in, like, I don't send out spam emails or nothing like that. It's just for me to see who's actually interested
Okay.
in this stuff. So just, but you can download all the slide decks and all the, this form and everything else. So
Okay, cool. Thank you.
yep, you're welcome. Okay, what else? Any other questions? Okay, well, I'm going to stop recording then. And